You got to have a diversification. You got to have fixed income, maybe a little bit of real estate exposure, maybe a little bit of gold to stabilize your portfolio. As Amit Rao, who's not here with us today, he had a very interesting thing to say. With equities, you can live well, but with fixed income, you can sleep well. So it's important that you have a mix of both in your portfolios. So uh, I think I will now hand over the mic to Gyan, who will introduce the speakers, and then we will take on the topics.
Thank you, Ganesh sir. Hey guys, good morning. Great to see so many people interested in our theme for today, which is investment beyond FDs and mutual funds. Uh, uh, like Ganesh sir said, it's also a very timely subject since the market being at all-time high. People are looking to cut down on their equity positions, but at the same time, where do you put in the cash that you get, right? Whether you put in FDs or whether you put in some other instruments, hopefully today's session will answer some of the queries that you might have on that front. Yeah, so moving on, I am supposed to introduce the speakers. The first speaker, I'm not sure whether it is an easy job to introduce him or it's difficult to introduce him. Because uh, usually, like Ganesh has said, we get around 40-50 registrations. Today we have more than 300 registrations. The last moment we were in a sort of panic. What to do now? So many people have kind of registered, and a lot of it can be attributed to our first speaker. He is one of the most popular voices when it comes to financial markets in India. Um, a regular presence on media platforms across as an expert. Uh, please join me in welcoming Deepak Shenoy. He's the CEO of Capital Minds, a SEBI registered portfolio manager, uh, which focuses on quant-backed strategies. He is 1996 batch computer science. Over to you, Deepak.
Thanks, Gyan. Always great to be here. I reconnected with an old friend from college yesterday. We hadn't spoken for I think 10 years, and like always, we always start talking as if we have not stopped talking ever since college. It just started off just like that. So college brings back a lot of great memories, but also it also strikes me quite dramatically that I'm almost hardly an engineer anymore. Mostly talking money and finance and all that. So let me just try and make the thing interesting. I'll share my screen. Can I do the present? Oh, I can't share my screen. Should I share my screen and start with the presentation? I think I
Sure.
need some permission. Oh yeah, I'll do that. So let me just share my screen itself. Okay. So I hope you can see this. This should work.
Yeah, we can see it, Deepak.
Yes, awesome. Okay, so I'm going to just quickly take you through, it's about 15 minutes. So I'll run through a little bit fast. We have a presentation about essentially FD suck. We know this. I'll show you how they suck, how badly, and then what's next. Because the markets are so high, everybody's a little scared to invest in them. Everybody also wants a little bit of safety. They've seen a 30% drop in the markets earlier this year. And even though markets have come back and rebounded fast, you don't want to see your 100 rupees becoming 70. Even if it came back to 100 by the end of the year. You're like, okay, I don't want that kind of volatility. So what's next? So there's some interesting options here. We'll go through some of them. One of them is, what are the FD rates right now? Some risky side of liquid mutual funds, and what are the alternate avenues? I'll keep it to fixed income for the most part, and I'll talk about the rest, as we go. FD rates, these are the FD rates we are seeing across the board. SBI, HDFC, and ICICI, some of the largest banks are less than 5% on renewal rate for FD. So this is 1 year fixed deposit interest. I think if you're a senior citizen, you'll get like 0.25 to 0.5% more. The highest banks are small finance banks, like Jana Financial Bank is giving more than 7% right now. But it's obviously a small finance bank. If you're scared of equities, you'll definitely be scared of small finance banks. Yes Bank also, which was giving 7.5%, 8%, is now giving 6.5%, maybe 7%, I think, for senior citizens. Uh, there's also companies like Bajaj Finance who are giving something, but you're seeing everything coming downwards. So what was 6.5, 7, 8% in the early part of this year has become 4.5, 5% now. Plus, when you put your money into an FD, there is tax deducted sometimes at source. Otherwise, you have to pay for the tax. So if you put 1 crore as a long-term saver into an FD and you get some money, it adds to your income and you have to pay tax on it. If you're paying 30% tax on what is anyway 5% on return, you're actually making like less than 3.5. Right? So it's pathetic that way. 6.5% also is equal to 4.55 post-tax. In the 30% bracket, you may be in a higher bracket and so on. So inflation is right now 6.93%. So effectively, your return is negative. Your inflation is higher than your return for the most part. So what beyond FDs? The answer is many people used to go to liquid funds earlier. Now there's a good reason why, because liquid fund taxation is slightly different. If you keep your money in a liquid fund and don't take out the principal, take out only the interest every month for cash flow. We had calculated that it saves you 80% tax compared to a fixed deposit. So what is fixed deposit? 6.55 comes down to 4.55 because of tax. In liquid fund, the same 6.5 return will mean 6%. Unfortunately, liquid fund returns in the short term and next few months or maybe a year and a half is extremely low. It's a 3%. So government is able to borrow for 3 months. Government borrows for lots of tenures, 3 months, 6 months, 1 year at different times. So today it's able to borrow the 3 month at 3%. That is now effectively the return that liquid funds are giving, 3%, 3.3% per year. Eventually, the government is borrowing this at the 10-year rate. It's the 10-year at 5.9%. So it pays more if you give it money for the longer term. So there's slightly a big difference between what they can borrow for 3 months, which is 3%, and 10-year, which is 5.9%. So the difference is 2.91%. This is one of the largest differences we have seen in India for a very, very, very long time. And eventually this money, the way we are looking at it and the way it's happening in the West, where interest rates are 0%, FDs are 0, in Europe it's actually negative rates. You might actually see that rates come down even further in India if, things don't continue in the right term. Interestingly, liquid fund expenses, liquid funds are mutual funds, right? So they invest in safe securities that give you money fast. So you can put your money into liquid funds, and they have the largest amount of money in mutual funds. So for instance, HDFC liquid fund is 100,000 crores plus that is sitting with it. Similarly, there are lots of others. There are about 5 to 7 lakh crores sitting in mutual funds. To give you an example, the total amount of money in equity funds put together, all of it, every kind of equity fund and all that, is still about 12 or 13 lakh crores. So roughly half of that, 7 lakh crores, not of that, of course, separate 7 lakh crores, sits only in liquid funds. So liquid funds are a very big category of funds. So there is also a tremendous amount of interest in this because these are considered to be relatively safe. Now, what is happening is if they give you 3%, they charge you an expense ratio. If they charge you 0.1%, you will make 2.9. So they'll take the expenses out of it and you'll make 2.9. Now, what has happened is the expense ratios of these liquid funds have started to increase. Now, you see this, it used to be very low, it should be 0.1%. Because they make 5%, they take 0.1, you get 4.9, everybody's happy. But now they make 3, and then they charge you these higher expense ratios, right? So everybody, HDFC has gone to 0.3% earlier last year. ICICI has also gone to beyond 0.3% this year. And Axis, Kotak, Nippon, all of these liquid fund TERs, we call them, have increased. So your returns as an investor comes even further down. Not only are the returns of the funds coming down, there's also the expense ratios that are going up. So your return gets even more constricted. your liquid fund returns are like this. Okay, so the last 1 year, the best return has been like 4.5%, and the worst return 3.75. If you take the 3 month ratios, in 3 months added up, they've given 0.8%. So this is roughly like 3% in the, if you analyze the last 3 months of returns. Now the problem with FTs is they'll, the liquid funds is they've been alternatives to fixed deposits for a long time, but now they're no longer alternatives. They're actually worse in terms of returns than FTs. Can we get better returns without compromising on risk? The answer here is there are many instruments, and I'll go through some of them. One is, this is for if you're 60 years plus, there's something called the PMVVY. The government allows you to invest up to 15 lakh rupees. The maximum is 15 lakh rupees. The return is 7.66. The government guarantees this, so this is relatively safe. You can lock in the interest rate for 10 years, but your money is also locked in for 10 years. You only get the money after 10 years. You can't get further, but if you surrender it earlier, you can surrender it earlier. There is a little bit of a penalty that is paid, but otherwise that's 2% of the purchase price. So you pay 2% to surrender it early, but otherwise it's available to you. So effectively, see, after about 6 months, you would have made about 3.5%. You can surrender and you'll still be fine. But the point is, you get 7.66. This interest rate will change, I think, every year. So up till March 2021, they have locked in return at 7.66. Per PAN, it is 15 lakhs. So if it's you plus your wife, you can put 30 lakhs in it and lock in the interest rate for that much if you don't need the money. So if you need the money, of course, that there are different options, but we'll come to that. Apart from this, there's a senior citizen savings scheme. Again, if you're above 60, that means, I suppose at this point, roughly KREC 82 and before that is something for whom this is useful. Senior citizen savings scheme has 7.4. So I talked about liquid funds at 3.5. FDs at 4.5 to 5% on average. And the higher interest rates, now the highest, this is the government backed things, right? So senior citizen savings scheme is 7.4%. This is again 5 years locked in, totally 8 years, because you can extend once for 3 more years. And this also gives you regular income. You can go to a bank, you can go to a public sector bank to get it. PMVVY is from LIC. You go to LIC website, you can buy it online also. They will ask you for some documents on email, and you can send it to them. For senior citizens, deposit also. It's about 1.5% of the deposit is the penalty. That means if you put 1 lakh, 1,500 rupees is the fine if you close it within a year. And beyond that, it's 1,000 rupees per lakh. You have to be minimum 60 years to get in, and the interest payment is quarterly. This is again, both of these options, the interest is taxed. So your net return comes most of this, but I'm assuming that tax is not so much a consideration. You guys want the cash flow to come in from there. There's another option. Again, those are limited senior citizens for 60 years plus and all that. There are RBI bonds where there's no age limit. You can buy it at any age. This is a maturity of 7 years. The interest on this bond is linked to the National Savings Certificate, the Post Office NSC, which is NSC plus 0.35%. So today, and as of until Jan 21, the interest is 7.15. They changed the rates of the NSCs. This rate will come down. It's a floating rate, but right now it's 7.15. So again, government guaranteed, RBI backed, 7.15 is the return that you're getting. Only problem is you're going to lock in for 7 years. The idea over here is that you can, your lock-in changes according to your age. If you're 60 plus, it's 6 years, not 7 years. If you're 70 plus, it becomes 5 years. 80 plus, it becomes 4 years. So it's locked in relatively smaller as you grow older. But also that you can charge, the penalty charges are 50% of the last coupon. That means if it's 7.15, then the penalty charge is 3.15 of the last coupon. So in the sense, if you put 1 crore in it, you get 7.15 lakhs to after 1 year. And then you will, if you want to get out at this point, they will charge you 3 point something lakhs to get out, which is effectively 3%, but it will be of the interest you've earned, not of the principal. So in a way, uh, that is the early exit focus. So you can buy this from a public sector bank or from select private sector banks. So there's only one option online, ICICI Direct. If you have an account there, I think you can buy this particular kind of RBI bond online. Otherwise, you have to contact the bank. They'll ask you for some documents, and then it can be stored with you. You can't sell the bond, even though it may be an RBI bond or called a bond. It's not available. This is, these are three options that come in. Then safe. I'm assuming you want really safe, because in this market, nothing is very safe. So you want as much government backing as possible. There's something called government securities. Now, these rates may not last forever, okay, because interest rates worldwide have come down. India is one of the highest interest rates worldwide, and even that is low according to us. But in Europe, they're charging you money to keep money in your bank. So it's like ulta interest. It's, if you put 100 rupees in the bank tomorrow, it will become 99, not becoming 101. So the interest rate fall, if it comes to India in the longer term, our rates today of 5%, 6% will seem like, oh my God, why didn't I lock it in? If you feel that way, you can buy government securities. So these are long-term securities issued by the government of India. You get 40, 30, 15, 20 years of maturity as well. So what we were talking about as 5% FD rates, even for 1, 2, 3 years, the government FD, effectively the government bond rates, are 5.8 for 10 years, 5% for 5 years, and 6.2 for 15 years. And even more, if you go to 30, 40, it's about 6.6, 6.7. So you can actually buy these bonds today. You can buy them on a brokerage platform. If there's a company called Zerodha, which is a broker. So every week the government holds auctions of these bonds. There are 10-year, 15-year, 30-year, all these bonds. You can buy them at 10,000 rupees increments. So you can buy 10,000, 20,000, 30,000 and all that. And you can buy any amount that you want. The interest will be paid to you once in 6 months. I'm just keeping a record of time. I know we have a short time, so I have about 13 minutes more. So I'm just rushing through this. I'll take any questions if you like. And there is also the fact that this is by the government. So effectively they can print money and give it to you. But the idea over here is this is the safest kind of available instrument. Currently, I think they don't allow more than 2 crore per PAN on an individual basis. But I think, this will change. Sorry, this may be wrong. This may be a little outdated, but I think you can invest even more. There's no TDS in any of these instruments in the ones that I talked about, and there's no lock-in in government bonds. So you can exit, but there's a problem because if the exchange prices go up, you will make a profit. If the exchange prices go down, you will make a loss if you get out before that 10 years. So you buy a 40-year bond and tomorrow you want the money, you might not get 100 rupees for the 100 rupees you invested. So also you may also not get, you may lose money. Why would you lose money? If the government increases interest rates, everybody expects a higher rate of interest in the economy. So your FD will remain the same if FDs are increased, right? But in a government bond, the price of the bond will fall. This reduces your return if you want to get out in the short term. But I am assuming you have, like Ganesh talked about asset allocation, you keep some money in fixed income, some money in stocks. As you grow older, you might say, I don't want to have too much risk on stocks, so I want more money in fixed income. So whatever money you have in fixed income, some part of it is something that you need urgently. Some part of it you don't mind locking in for 10, 15 years. Because if I have 1 crore rupees and 50 lakh rupees I want to store in fixed income, I don't mind locking in some maybe 5 or 10 lakhs for 10 years and another 5 or 10 lakhs for 5 years. Then I need only 20, 30 lakhs available to me just in case something happens and all that. So that asset allocation concept, if you do, some parts of it you can put in government securities, some part in PMVVY and so on. The idea is that to try to maximize your interest rate, reduce the change the way you allocate your fixed income to these. Uh, sorry, here. So here's where here is also something that you can consider once. Now, I'm assuming some of you will be at the extremely high tax brackets, beyond 35-40%. You may be getting a pension or a salary or a consulting income or a multiple other incomes. So whatever interest you earn is charged 35%, 33% plus. This means that your net return comes down if you put it into FDs, into everything. But maybe you also are looking for something that gives you steady cash flow. There used to be something called tax-free bonds by PSUs, like National Highways Authority, REC, that's a Rural Electrification Corporation. There is a couple of others, Indian Railways Finance Corporation, and so on. The interest payment was mostly quarterly or annual. Each PSU company issued a lot of these bonds in 2011 to 2014 or so. So roughly those years, they issued them between 5, 10, 7. There's this kind of maturities. So you currently have these bonds that are trading in the market. So if you have a brokerage account, you can actually go and buy them online. They're at multiples of 1,000 rupees each or something. And the yield, which is tax free, that means whatever interest they pay you, you don't have to pay tax on this. And this is between 4.2 and 4.5%. Now you can get in touch with me or with anybody on the investment group. I guess they can help you with trying to get a hold of these bonds. But 4.2% tax free. If you're at the highest rate of 42.74, that is the extreme high, it's equal to a pre-tax return of 7.15%. Right? So if you want cash flow at that high level, I know people who are extremely rich also who want that regular cash flow to come in from some of their deposits. The rest of it can be wherever, but that that return is equal to 7.15% at 42%. So 4.2 tax free is still worth about 6.5%, even at a 30% tax bracket. So this is actually pretty good because you get high rated bonds and all that. So now you got a complex option. You got tax free bonds, you got government bonds, you got PMVVY, RBI bonds, and so on. Different kind of bonds here in tax free. These are the rates I got 2-3 days ago. We will send you these presentations. So you got IRFC and REC, IFCL. These are just government-owned organizations. REC is public. IRFC, I think, is an IPO coming either later this month or something. So you can see their financials as well. But largely, these are considered to be government-backed and therefore given the highest rating possible, that is AAA. And their yields are given over here. That means this is post-tax. This is once you get this money, you don't have to pay any tax on it. Okay, so let's now look at, okay, I have 1 crore, let us say, and I want to invest it for about 7 years. I have different options. If I put it in a fixed deposit at 5% interest rate, you can see what it becomes. 1 crore becomes 1.41. If you're uncomfortable thinking in crores, think in lakhs. But I just say, put the number in there. So 1 crore become 1.4 crores in 5 years. I'm talking effectively pre-tax comparison for all of these. So 1 becomes 1.41 in FD. Government securities of roughly the same tenure or around that is about 5.6%, which becomes 5 lakhs more. So 1.1 crore becomes 1 crore 46 lakhs. RBI bonds, the same thing at this 7.15 rate is 1 crore becomes 1.6 crores, 1.62 crores. So you get a 62 lakh interest. So 40 instead of 41 from a fixed deposit, you get 62 in RBI bonds. 65 lakhs in the SC Senior Citizen Savings Scheme. About the same, 66 in tax-free bonds effectively after tax, but you'll get your cash flow is lower. It's about 43 or 44 lakhs, but it's after tax. But pre-tax comparison is that much. And the best is about the Prime Minister Y Vandana, which is this LIC scheme for more than 60 years old people. That's 68 lakhs. So this is all pre-tax, just an idea of how much you can make. So it's not only the FD returns that are come. Before I go into questions, just to say, we also, of course, do more. There's always more risky stuff and interesting stuff. The best is equities, of course. The simple things that you can do with equities, so whatever equity allocation you have, you can do something as simple as buy an Indian Nifty and the US NASDAQ 100. Both of them are available as mutual funds in India. One is a Nifty mutual fund by a bunch of people, including UTI, SBI. You just have to buy something called a Nifty index fund. There is the expense ratio I talked about in liquid fund, no, is 0.3%. In many of these, it's 0.1%, 0.05%. So it's even lower as an expense ratio. So you get the top 50 companies in India, which is the Nifty, in one block at a very low expense ratio. Another one, if you add US NASDAQ 100, you get Apple, you'll get Amazon, you'll get Google, you'll get Facebook, and all the, even Zoom, which is part of the NASDAQ 100. So that kind of gives you a basket of India plus international, very simple to do, execute. You could also go into mutual funds directly. Direct stocks, I mean, everybody loves it, because you hear about, even everything's going up nowadays. So you got to be careful when everybody is going into it. When nobody talks about it, it's a great time to invest in the stock market. But when everybody's talking about it, it just becomes a little more scary. I've seen, many of us have seen many bull and bear markets. But when the market becomes extremely bullish, it usually does not end very well, very fast. So there'll be a time when the market corrects and shakes everybody out. And when you're going in thinking I have 100 rupees, you don't want to see it becoming 40, 50, 60 rupees before it, even though it eventually may go up. That you should optimize for gut lining, or in Hindi they call it jigar. It's like how much how jigar is actually liver, but the liver is one of the most useful parts of your body, right? So it's not given much importance. But when you cannot take it anymore, is why when it becomes too difficult. So it's focus on the risk more than the reward. But direct stocks are also some ways to make great amounts of money, because even some stocks, even if you invest in 50, 10, 20, 30 stocks, even 3, 4 stocks can give you so much return that it can give you more than whatever the other stocks didn't make. To give you an example, just the Nifty stocks in the last 10 years, only about 5 have returned better than inflation. What are the 50 stocks? 50 out of 50, about 7, sorry, have returned more than inflation in the last 10 years. But those 7 have given you so much return that the overall Nifty return is higher than inflation in the last 10 years. So that way, the idea of stocks is to build a portfolio and do this. One is, of course, selecting stocks. You can go quantitative, which is what I like to do. This is where a little bit of my engineering background comes into play, where we do a lot of algo based and strategies based on discipline, which you can backtest. So we say, so some simple things like, for instance, if a stock is below its 200-day average, then it's a good stock, so we want to buy it. And we want to rank such stocks based on maybe various parameters like volumes and strength of the move and participation ratios and so on. All these data is available on the internet, and you can grab all of this and put them into an algorithm and say, how has this algorithm done in the past? So there's something called momentum, where we do this, where we buy stocks with high momentum. And this tends to give you very interesting returns, because not only did it give us great returns, about 40% plus in the last 1 year, but it also limited the downside to about 12% when the market fell 30%, because the algorithm automatically said, get out. And we didn't know why, but we just had the discipline to get out. So that is something we do at Capital Mind Wealth, very do-it-yourself, very frequent strategy. There's other asset classes. I think we're going to hear about REIT and InvIT later today, right now, immediately. There's also, you can invest in startups. A lot of KREC and NITKSAA startups are out there. Some of them are looking for money as well. Some of them might actually give you great returns. Like the recent IPO of Airbnb, I think was a 700,000% for the earliest investors. So you don't know which the next Airbnb could be. And therefore, if you invest in some of them, you might get those outsized returns. Very risky, but also very interesting, intellectually challenging as well. I mean, how much intellectual challenge can you get in buying an FD? It's just not So if you're looking for that, maybe part of your portfolio, 3-4% of your portfolio, you want to place in these intellectually challenging things, that's startups for you. Two things don't do. Don't buy debt of stuff that you don't know. You'll get a lot of offers. Oh, we'll buy market linked debentures, this, that. So somebody's giving you this and somebody's giving you that. All that stuff, if you not understand it, don't buy it. There's a lot of debt of shady companies. SREI is one of them that's going through a crisis right now, but its debt was sold aggressively as, oh, it's giving you 9% plus last year. Yes Bank's 81 bonds. Many of you may have seen or heard of the pitches. They said, oh, this is a bank bond. It is giving you 8%, 9%, 11%. Right now, industry 81s are giving you 11%. These are called additional tier ones. To give you a history, RBI has cancelled the 81 bonds of Yes Bank when it rescued it. So that means our principal gone, interest gone. It's gone, zero. So risk-free return has become no risk. No return. Sorry.
Sorry, you got just about time. Anyway, you can wind up.
Sorry, I'll just wind up here. We do a bunch of things at Capital Mind to help invest. We have a PMS as well, and we have fixed income in that PMS as well. But also, as I said, this is not something that is very so complicated that you can't do it yourself. So I've enumerated the options just to look at it. It's historically looking, this is the worst time to invest in fixed deposits, lowest yields ever. Don't compromise. If you don't want to compromise on risk, you got sovereign and PSU kind of credit rating instruments available at 7% plus. Okay, so I'll kind of wind up. Any questions?
Deepak, we'll do the Q&A after next session. Yeah. Awesome. Thank you so much.
Yeah, thank you, Deepak. Thank you very much. That was a fabulous presentation, especially for our folks who are not very active in the market or in the investment field. See, it's correctly said that it's not good enough only to save. It's necessary to correctly invest. Only then your money can work for itself and for you. So Deepak has given us a lot of safe and sound ideas, which is very nice. But at the same time, some of us do have a little more risk-taking ability in the interest of probably getting a couple of % interest more or returns more. So Parikshit Kandpal, who's the next speaker, will come out with another presentation of some such other options which have come in fairly newly into the market. Of course, as Deepak said, they do carry a certain amount of higher risk. But if your appetite for risk is good enough for equities, then probably these are also some things you could look at. So over to you, Parikshit, and welcome on to the group.
Yeah, hi, sir. Thanks for this opportunity. After a good session from Shenoy, sir, I think now I am going to some boring stuff on REITs and InvITs. So can you please allow me to share the screen, or if you can put my presentation? I'm not able to.
Are you sharing your screen?
Because my PPT is not coming up. It's showing host disabled the participant screen sharing.
Okay. Let me see.
Or you have my presentation if you can host it on the. Yeah, I can now do that.
You're able to do it?
Yes.
Hi,
can you?
Yeah.
So guys, I track purely equities at HDFC Securities. I cover some of the very high beta sectors, which are like infrastructure, capital goods, and real estate. But today I'm going to discuss more about InvITs and REITs. Maybe at some time later we can have another session on purely on the equity side. One second. Yeah. So InvITs have found some interest. So first InvITs to list was IRB Infrastructure InvIT Fund, which was listed 3 years back. So this InvIT has not really done well. The issue price of 102 odd rupees, it is now trading at 44 rupees. So what does the InvIT do is basically it has got pool of assets. So in case of IRB InvIT, there are some 7-8 road projects which they have in the portfolio housed in SPVs. So they collect toll from this assets, and this toll is basically distributed as dividend or interest or return of capital. So the trust has raised capital from the investors in the market, and they have given it as a loan to most of these SPVs and retired their bank debt. And now these SPVs are servicing the interest on this loan. Plus, they also repay debt, which is being given by the trust, and which comes as a return of capital. So large part, almost the entire distribution is getting taxed here because interest is taxable at your marginal tax rate. The return of capital, basically the repayment of debt, is not taxable. And now you have dividends. So dividend, as of now, they're not paying any dividends, but as the debt repayment proceeds, they will start paying dividend. And in this case, they have not opted for lower tax rate, corporate tax rate. So here, the dividend will be tax-free. Okay. So now, if you see after COVID, what has happened is that the toll assets have seen very strong growth. So these are typically the road InvITs, which have underlying toll assets. They are growth options. So here, if the toll is growing, toll revenues are growing, so it's a big positive for the InvIT. So in case of IRB, now we have seen last 3 months, October, November, so September, October, November, so there has been a very strong recovery in tolling numbers across India. And we have seen about 16% and 12% and 10% YOY growth. Okay, so this is a positive for the company, but there are concerns on large 2 projects which are moving out of, which can contribute about half of the net operating income. So NOI, which they distribute from the toll collection. So 2 large assets which contribute about 50% of the portfolio revenues are going out in next 2 years. That's why the stock has halved. So right now, till now, they have distributed on an average about 10 to 12 rupees per annum. 36 rupees they have distributed. So 102 rupees they have distributed about 36 rupees. The stock is trading at 44. It's a very risky stock. In my worst case assumptions, which I've run across the portfolio, and also have interacted with some of the very leading traffic consultants in India, the guys who basically advise large sovereign wealth fund for investing in their toll assets in India. So base case, we can expect about 5 to 6 rupees of sustainable dividend, which will keep coming in from this InvIT, which itself is about 12-13% on the current price. But I would say it's a risky, very risky InvIT because here, if the growth doesn't come in, so then the DQ can fall further. So if someone has a very high risk appetite, they can look at this asset. Second one, so unit holding is also a little bit of like IRB Infrastructure is the largest unit holder. The rest of them are the very reputed funds. So people do have concerns about the IRB group being the largest shareholder here and also a sponsor. Otherwise, the rest of the shareholders look pretty decent, like Government of Singapore, Aditya Birla Mutual Fund. So a lot of FIs are there. So if there is some correction in the market and if you get the opportunity to buy the stock at 30-35 rupees, it'll be a good buy because for next 2 years, they will be giving about 20 rupees dividend. So 5, I think, in the second half of this financial year and 10 rupees next year, and another 5 rupees in the FY23 first half. So 20 rupees you can get in next 1.5 years. So if you get it closer to 25 to 30 range, it could be a good buy because the residual life of the asset is another 20 years. And if you get about 4 to 5 rupees per year, it will be quite a decent buy. Okay, so this was about IRB InvIT. So now I'll talk about Ind Infravit. So IndiGrid Trust. So this is a power. They house the transmission line, power transmission lines. So large transmission lines which connect the grid and make the power available to the consumers like us. So this is relatively very safe kind of a portfolio because there is no revenue risk. There is a fixed revenue which they get from the power grid for making availability of the network to the grids. So here, there is no revenue risk. There is no little bit of interest rate risk because they have a borrowing almost like 53% debt equity ratio. So they have external debt on the books, which they have used to fund these transmission line acquisition. So there is interest rate risk. If the interest rates go up, there could be a slight higher interest outgo. But this is a very safe asset. They have been maintaining the network at greater than 90% availability. to the network and they get some incentives there. They have been distributing, till now they have distributed close to 39.56 rupees DPU since inception, and they have been distributing about 12 rupees per annum. So 3 rupees per quarter has been the distribution from their side. And the asset acquisitions that they have done recently, and they have a huge pipeline right now. About 14,000 crores is the asset under management, and they expect it to take over 30,000 crores over next few years. So the intention is to maintain about 12 rupees per unit of DPU every year, which is paid out in 4 installments, 4 quarterly installments of 3 rupees per unit every quarter. So on a price of 113 odd, it's almost 11-12% kind of a yield. A very safe asset, AAA rated asset. If I go into the sponsor, you see the largest sponsor is basically KKR has opted for becoming a sponsor. The Sterlite Group is already out. They hardly own. I mean, they hold just less than some 0.2 or 0.3% kind of stake in the overall this asset. Now they have exited. So GIC is the second largest shareholder. So if you see the shareholding, it inspires confidence and trust in the, because there are a lot of marquee investors in this name, so which augur well for investors' interest, and that's the reason also why the stock has got so much re-rated over the years. Okay. So this is one stock one can look at. The only risk here is someone is really worried about like whether they'll get the capital, so 113 rupees which they are investing to buy this asset. So whether they'll get it back. So I would say the risk would be in case there is some natural calamity. Say they have got some transmission lines in some high seismic zones like Kashmir and some of the other reasons. So if there is some earthquake or something, so then the part of that would be insured, but this could be the risk which could pan out. Second thing is the payments from the SEB. So there's a concern that the state electricity board may not pay money. There could be delays, but here the collection is done through a pooling mechanism, and Power Grid basically makes the payment. So as of now, we have not seen any issues with regards to payments or the cash flows from these assets. So this is one InvIT which I'll recommend. One can benefit from. The only thing is that the dividend is largely distributed here at as interest and return of capital, and even in future if they distribute any dividend, if there is any surplus profit after servicing the interest, they have opted for lower tax rate, so it will again be taxable at your marginal tax rate. So it will slightly a little bit of non-tax efficient. So you'll be all the distributions here will be charged at your marginal tax rate. So now coming to, so these two asset classes on the infrastructure side, I had discussed IRV and Integrate. Now coming to REITs, so I cover real estate sector as well. So here, if you see REITs house hospitality assets, office assets, hotels, mall assets in different SPVs, and the rentals which they collect on these assets typically are distributed as, again, the similar fashion. The three sources of distribution. One is the interest payment, second is the return of capital, and third is dividend. Okay, so now here of late there has been concern on work from home and longevity of these assets generating growth. So typically, if you see how these agreements are structured, is that you have a 3-year time frame wherein you get 15% escalations on an average annually. You get about 5% kind of escalation. Plus, you have a mark-to-market potential. So typically, these assets are leased out on a long-term lease. So they are 5-year, 10-year contract. So sometimes what happens is that when you enter into an agreement with the anchor client, say like IBM, so you go maybe at slightly, if you had gone it maybe that during 2009 or 10 when there was recession, so your rates will be much lower than the current prevailing market rate. So most of these assets exhibit about 25 to 30% market potential. So once they come for renewal, there could be a big bump up in the rentals to the extent of 25-30%. But work from home has done one thing is that most of the people will come for negotiations. I would assume today Google has announced that 3 days working week, so 2 days work from home. So the offices will become smaller, they'll shrink. So after the COVID vaccine is administered, so as of now, most of the tenants are focusing on work and safety of their employees. And that's the reason they are not taking any decisions on cutting down the office size. But I would say there is a pain in this asset class over next 2 to 3 years. Likely pain can happen if the vacancy increases. But the dividend yield here is about 7% for Embassy and Mindspace. So both has about 7% dividend yield, which can be still maintained if there is no growth. So you can expect a minimum 7% kind of a dividend yield if there is if the space is not given up. And if the things return to normalcy, you can expect about 5% of growth, which will come in rental growth of 5% every year, and about 7% of dividend yields. So this asset class can give you about 10 to 12% return. Here, Mindspace is more tax efficient because they have not opted for lower tax rate. They are at higher tax rate. So their dividend will be entirely free in the hands of the investors. I think 70% of that distribution will be through dividends. So unlike in FBC, large part of dividend comes in from the interest part. So between the two, if I have to choose, I would be slightly on favor and Mindspace because of the most tax efficient structure. Last bit which I've added is like someone is looking to add is like CPSC ETF is also CPSC ETF is also a good option, or individually also if someone is looking for high dividend stocks or some of this CPSC ETF holds the portfolio typically has very high dividend yielding stocks. So one can look at Coal India, one can look at Power Grid or NTPC separately because these three have almost very high dividend yield even at the current prices. But I would suggest to go for CPSC ETF because it is more tax efficient. Here the dividends will get reflected in your NAV, and plus most of the PSUs are at depressed prices. So as the recovery pans out, you will also get capital gains which will accrue because of the fixation in stock prices of these PSU stocks. So you get capital growth because of capital appreciation because the stock price is going up, plus the dividends, which is almost I think 5% dividend yield at the current prices. It need not pay tax. If you individually hold these stocks, you'll have to pay tax at your marginal tax rate. But in this case, it is getting reflected in NAV. So you will only pay the capital gains once you basically take the CPSC ETF. Okay, so this was one option. And one thing which I also like to add is, which I've not mentioned, is that if someone is looking at long-term kind of a very safe instrument for investing in bond, there's one more option. One can look at Bharat Bond ETF April 2031. So there's almost 11-year kind of a zero coupon bond. There is no interest rate risk, literally. There's no credit risk. So it's 6.25% is what you can get on a compounded basis at the maturity. It's available on NSE, BSE. You can buy it from your broker. Gives you almost 2031 gives you almost like 6.25% of yield. And it's zero coupon, so you don't have like any reinvestment risk here. It holds portfolio of very highly rated PSU stocks, so there's limited, very less or very low credit risk. So this would be one option one can look at investing as an alternative to FDs. Yeah, so I think my time is over, Ganesh sir. I think
Thank you, Parikshit. It was an excellent presentation. Of course, a lot of data. So we will share this presentation and Deepak's presentation to all the registered members here so that they can digest this at their own pace. So now we will open this floor for a couple of questions. If anybody has any questions, they can unmute and ask, or even put it on the chat. So Deepak, you can also join in.
Yeah, I don't think people can unmute.
But they can't.
Because, yeah.
Okay. Till somebody comes out with a question, let me ask a question to both of to Deepak.
Ganesh sir, I can enable everybody to unmute if that's what is required.
Okay, for a short while we can do that.
Okay, I will ask. Basically, I have made allow participants to unmute. So whoever has to speak can unmute now themselves.
Yeah. So one question which I would ask on behalf of the audience is nowadays there are a lot of these UP state guaranteed power bonds and things like that. So Deepak, what do you think about them? How safe are the UP state guarantees?
So this there's a bond basically by UP, the power company, the UP Electricity Board. It's quasi guaranteed, and I say quasi, I mean there's an actual statement of guarantee between the state government and the Electricity Board saying we will take care of any payments in case the state will take care of any payments in case this thing doesn't. The problem with this is you'll have to see the structure of these agreements. The governments of the past have governments change, right? So sometimes they come back and say, what guarantee? Yeah, we don't want to honor this guarantee. Find a way. So the legal fellows will find a way. So you have to be careful about that. UP seems to be reasonably safe. There was another bond called Amravati. So they also are still yielding 11%. There is maybe no development at Amravati, but AP government is still honoring those payments. Okay, so there's no delay in those payments, but it's still, I think, according to me, there's an area of risk. However, like I said, we have to take some risk, right? 10-11% is not a problem. So if the problem is it's 10 lakhs per bond, so unless you have 1 crore or 2 crores, you don't want this bond because it will be too high a percentage of your.
True. Yeah, another question. Although you said 81 bonds are avoidable, definitely, I also agree. But what about SBI bonds? Of course, they are perpetual. They are also called 81s.
Yeah, the only issue is, I'll tell you what the problem is. Actually, it's a weird thing. It may not be that the bank goes down. So the way these 81 bonds are structured is, the bond is given to you as if it's tier 1 capital. Now, capital and bonds are very different things, right? Capital is equity usually, and bonds are bonds. So bonds have a higher recovery in case of liquidation than equity. But these specific bonds are actually worse than equity. I'll tell you why. Because RBI can say, listen, Ganesh, I know you have 81 bonds, but you know what? We don't feel like it this year for whatever reason.
Yeah.
We won't pay you. We won't pay you interest. We will pay you part of your principal. You gave us 10 lakhs, I'll give you back only 5, maybe. So the problem is the RBI can do this without you even being involved in the decision making. And therefore, you have that risk of tomorrow, let us say after COVID, this Supreme Court case on NPAs that's going on, suddenly we discover huge NPAs are there in the system.
Right.
RBI is going to say, yeah, all these banks are in trouble. So what do I do? Well, why don't we catch the lowest end guys? Oh, these 81 fellows. Okay, we tell them we won't return their capital. Suddenly that becomes almost like equity capital is added to the bank without having to issue new shares also. So it's, Yes Bank got 10,000 crores of free capital because they wrote off all the 81 bonds. Not 10,000, 7,000, some crazy number. But the idea was that, so if they do this, not write down, maybe even say, I won't give you interest. That will finish off the 81 market. You won't even be able to sell these bonds. They're perpetual. You don't know when our SBI will start servicing them again. And then, that is the problem. So that I think is something you have to be careful about. And I just see that, the tail risk is too much. That one thing will not allow you to sleep at night.
Okay. Good. I think that answers the question. Anybody else has any questions before we
just to add, I think some of you have been asking for direct stock tips. I don't think experts would be able to share that.
Yeah.
However, I think you can join the investment group. There we keep on discussing these things.
Yes.
So better to take it over there.
True.
So Deepak sir, I had one question in general about, you said investing in startups and stuff. So as an individual, how can I invest in startups as an angel investor or as a VC, or is there a way to do fractional investments and stuff?
Yeah, I mean, so the thing is, investment in startups is just writing them a check and then getting some shares in return, right? So there are a lot of people here who are, of course, far more knowledgeable about it than me. But let's say you want to invest in my company. You gave my company some money, I gave you some shares in return. Tomorrow I become public or go IPO or something. Let's say you own 1% of my company and you have invested, say, 10 lakhs in that company at a valuation of 10 crores. 1% of 10 crores is 10 lakhs. But tomorrow I go public at, say, 1,000 crore valuation because I become very big. That same 1% of yours is now worth 10 crores, not 10 lakhs. So you've got 100x return on that. On the other hand, I might go bust because my business idea may not work. Your 10 lakhs becomes zero because there's nothing else to sell it. And because you've given it to me as equity, there is no reason for my company to pay it back. So it's a highly risky but highly rewarding instrument as well sometimes. The problem in India is the reward part hasn't been obvious. Though many people in KRECs themselves, I've seen, from many fields have made enormous amounts of returns for their investors. So still, I would say, this has a risk element to it, a very big risk element to it. So investing is very easy. it's much easier. I mean, nowadays, some of these startups do demat accounts, but otherwise they should give you physical shares. So it's almost like
No, but the question is like a public company, I can evaluate based on the public news of it and what the analysts say about it. But startups, how do I evaluate as a small time investor?
Yeah, so this is the risk part where you have to go in through the books, get trust the persons involved. It's literally mostly these kind of investments are done on I trust you, just please go and get me give me a part of your company kind of thing. So it's not
okay. Thank you.
Hello, I have a related question. Hello, this is Umanat Naik. Just as he said about startups, what is the opportunity in, say, unlisted companies? Sometimes there are very good unlisted companies. If you want to invest, is there a avenue for doing that?
Yes. I think biggest things recently have been HDB Financial, Hero Finance. They called pre-IPO investment. Sometimes NSE also. I think the National Stock Exchange also shares are available. Many of them will give you only shares if you invest, say, 5 lakhs, 10 lakhs, or multiples of those numbers. But the idea over here is very simple. They're bigger, more established companies, maybe Zomato, maybe all of those. Maybe the insiders are selling because they want some liquidity. So they're not listed on stock exchanges. Their valuations, again, over here, your problem is this. You may not find a buyer for your shares. You have to hold these shares for a really long time. You don't know who else will buy. But if you can evaluate these companies from the valuation perspective and say whether it's valid or useful or not. To give you an example, today Zomato is valued at higher than one of the companies that owns it, called InfoEdge. You're paying $5 billion for, let us say, a Zomato. Is that worth it? You'll have to figure that out because there's no metric, there's no stock market, there's no trading happening to figure out if that is the right value for it.
So it's a risk there. It's a big risk.
It is a risk.
Okay, thank you.
And one more question, if you don't mind. What about commodities? You have not touched about commodities in your whole presentation. Either you or Parikshit.
Umanat, I think that will require a special session.
Okay.
No, mainly because we want to keep to timings.
Oh, sure. Yeah.
And
no
so I think really enlightening and excellent participation. We really appreciate this one. Now, I think the next thing, of course, we will be doing is giving a little time for some of the participants here to present themselves. Our investment groups have been very active. And therefore, we also have some people with whom we have been only mainly dealing or talking on WhatsApp groups, but not seen them face to face. So some of them will be coming on screen shortly. And before that, of course, we are going to give a 30 seconds time to Shesh from Beehive to present his company. I mean, he's been a sponsor for this show and for the Zoom meeting. So over to you, Shesh.
Okay. All right. Yeah. Thank you so much. And I think Udupa sir had that screenshot. You want to get to that? Yeah. If we can make it full screen. So basically, yeah, thank you so much. I think I'm really happy that I got the opportunity to be able to sponsor on this, and amazing to see such a huge response. Looks like this is one of the largest, and hopefully, it would continue with such big response. So very quickly, so basically some of you were asking about startup investment. So we have started a company which is a fintech company which will help. So there are two things to it. We are raising money for the startup itself. Of course, it's a high risk, and I speak about more risk when we speak about it. Startup investment is high risk, but people do invest. Even I invest in startups. So we are raising money for the platform. Also, basically, this is a platform that will help people invest in high yield generating commercial real estate. So if you become a customer of the platform, you will actually get shares of different properties, which is legally backed. There's a clear legal framework where you'll actually get certain percentage. You can even buy 1% of 100 crore property or 0.5% of 100 crore property. So we are creating that mechanism to help retail investors invest, because it's the same problem which I think was discussed today. Returns have reduced in other fixed income monthly income sources. This gives very good returns comparable to REITs, but there are differences because here which specific property you're investing. So there are 2 time slots this weekend. Both the time slots are suitable for India, Southeast Asia, Middle East, and Europe. I will share across it. You can see on the screen the timings. I will share more details later. It will be available on my Facebook as well. Okay. Thank you so much.
Thank you, Saish. It's definitely an interesting proposition, and I think people should consider, at least evaluating and then investing. Okay, now I think I would like to invite. We will be inviting on screen one by one. I think the list has been mailed to the participants who will be called. So we request you all to be ready as and when you're called, so that you can use your 30 seconds usefully. Essentially, we request you to, of course, show your face so that everybody is familiar with you, and tell us a little bit about your, of course, your batch, where you're staying, and what you've been doing.
ನಾನು ஏதோ இப்ப பேசுறேன் மத்தியத்துல அது ஜோர கிரிச்சுவான் ஆத்மீங்க.
Okay, Ramki, you're on. Need to mute.
Okay.
Okay, let's start with Ramki. Let's start with Ramki.
Yes.
No. Ramki is there. Excuse me. Ramki is in between, please.
Yeah, you want to go by the
order. Yeah.
Okay, good. So Gurudat Malya.
One second. I'm just sharing. Yeah.
We can unshare the screen.
Gurudat Malya is not there. Okay, go ahead. Next.
Raghvendra, you are Acharya.
Please unmute and speak, please. Unmute, put on the video. Yes. Ramki, please hold on. You are there later.
Vijay, would you like to take on this?
No. Go ahead, please.
No, take it on. No issue.
No, please.
Okay. Rajan Malhotra. Not there. Pradeep Hiremat.
Yeah, I'm here. Okay, this is Pradeep. I can't
video?
the video for some reason.
Your video is not working. Okay.
Yeah, it's not. I don't know how to fix this. Okay. All right. So this is Pradeep. Been worked with Ganesh sometime. We started some startup venture and we worked for a little while on that. But I've been in the US for almost about 22 years, been an IT entrepreneur, built and sold the companies. Then I moved back to India in the last 13 years. I've been in India. So recently I've become a very active investor both in the US market and the Indian market. I used to be a very high risk taker earlier, so they did not pan out. So in the stock market, but now I've been very careful balancing the risk and reward. And fortunately, the last 1 year, both in the US and the Indian market have been extremely good to me. So I am heavily into equities. I do keep talking to Ganesh to spread it across, do the asset allocations. So I've been kind of moving some of the monies into the fixed returns kind of a thing. So I've been extremely active in the investment per se. That's it.
Thank you, Pradeep. Thank you very much. Next is Srinivas B.
Good morning, everyone. Nice session. I could join very late, but I'm happy to get connected. I have just retired 2 months back from the Army, an engineer officer, and have been investing regularly in a disciplined way over the last 30 years, but not at all financially wise. So it's great to get connected. Look forward for a good association. Trust is a big word. Trust, faith, goodwill are these key words that I look at with safe investment and wealth creation. That gives a satisfaction of belonging to the college fraternity. I look forward for the experts willingly would like to participate in every possible way. Thank you once again. Well organized. We'll continue with this association.
Thank you. May I call Gajanan? Is Gajanan around? Okay. Prabita. Others on the, please unmute yourself before your name is called so that you're ready when your turn comes. So we call Ramanand Kamath.
Hello, Ramanand here.
Yes, we can hear you.
Just a second, I need to see. Am I visible?
Yes, you are visible also.
Yes. Okay, fine. Right, I'm into short-term trading. I'm from AAA 2003 batch. Right now, like what happened is like some of the guys had asked. Just 1 second, let me share my screen. Sorry. Okay, fine. Like if you want to take risk and you want to put money in stocks, that's like what you can do is you can look for relative strength of a particular sector comparatively to Nifty 500 or BSE 500, and then you can look for which is moving, the momentum stocks. You get opportunity to make money for a short time, for a few weeks, or maybe for a couple of months. There is risk, but there is equivalently very good reward. So keep this in mind. You want to look in stocks, look for relative strength.
Thank you. Thank you, Ramanand. Ramanand has been the backbone of our ST, that is short-term investment group. I mean, he's really been hand-holding everybody in the group, and it's a pleasure to work with him.
Thank you.
Rajiv? Rajiv, are you there? There you go.
Good morning, everyone. So I graduated from NITK in 2003, computer engineering. So I have my own startup in the field of high frequency and algorithmic trading. So we make markets in thousands of instruments on the exchange on a daily basis. So potentially we might be managing the broadest derivative book in India on a daily basis. Carry overnight positions in thousands of instruments and so on. We also have we recently launched a PMS of our own. So it's an arbitrage fund, so which returns upwards of 15% annualized. So launched 2 months back and then tested and for over 10 years of data and so on and so forth. We have been running it in-house for over 3 years, close to 4 years now. And we also have an education business. It goes by the name of Quandency. So wherein we have students from over 190 countries in our online self-learning modules, and then over 80 countries in our dedicated classroom program, which is like 4 months plus classroom program. So that is again in the field of quantitative and algorithmic trading. So that is what we do.
Thank you, Rajiv. Very interesting. High frequency trading, it's something very specialized, and it's good for you to bring that perspective into the group. Pavitra? Pavitra, are you there?
Okay. Yeah. Ganesh, can I go?
Yes, Ramki, you can go.
Okay. Good morning to all of you. My name is Ramkrishna. I'm a 1980 pass out from KREC in chemical engineering. What you see on the screen is the social venture that we formed, and it's been operational for the last 2.5, 3 years. But the original trust, the Sneha Trust, was set up about 13 years ago. And I'd like to draw your attention to this program, Vidya Unnati, which is a program to support educational opportunities and career progression opportunities for underprivileged children from 8th, 9th, and 10th standard. In the first place, I actually enjoyed Deepak Shenoy's presentation, because he had absolutely no qualms in saying that 1 crore on the as an investment corpus. So that is our immediate goal too. NITK Sneha, we want to raise the funding for our program to support 1,000 children over the next 3 years, and we are hoping that with so much interest in how we can maximize our wealth, some of that wealth flows back into NITK Sneha. So we're looking forward to your support, and thank you very much.
Thank you, Ramki. That is a nice initiative you're following and you're taken up. May the force be with you.
Yeah, thank you, Ganesh.
Next is Saurabh Jain. Are you there, Saurabh?
Hello, everyone. This is Saurabh Jain. I am from 2008 mining batch. Before my current work, I work in Microsoft as a senior program manager. Before that, I was working with Zest Money, which is a fintech lending company, for almost close to 5 years. Started almost from the day one. From today's session, I mean, what I'm taking with me, the few points. The reason I was taking notes was just to take 1 or 2 points, which I could kind of retain. The thing about my growing liking for the index funds, I'm a regular participant in the WhatsApp groups, plus I'm investing via regular SIPs into mutual funds. But then with time, with office and how much time we kind of have is something I'm trying to, let's say, automate my investment strategy so that you kind of, they are on all auto mode and you can keep monitoring. That's the thing I'm looking for. But then I also know that you need to diversify, as Ganesh said. So real estate, mutual funds, and debt versus equity portfolio settlement is what I'm looking forward to. And then the group here is always there to kind of guide you through. So yeah, that's my key points from today's session.
Thank you, Saurabh. Next would be Soumya. Are you there, Soumya? I request the next names also to get ready so that they can come on as soon as they're called. So the next is for Shilpa, Nisha, Vinita, all absent. Monal,
No
Chandni.
KRC type proxies here.
No proxy also. क्या हो रहा है? Okay. Chandni, Manisha, Deepesh.
Not taking physical breakfast.
Varun.
Hi everyone. Good morning. I'm Varun Francis from mechanical batch of 2019. Currently based in Bangalore. Recently started a new venture called Gold Teller. What we're essentially trying to do is address a big gap in the market for financial planning, especially for non-HNIs and ultra HNIs. So we're essentially trying to replace the traditional financial planning route through technology, through automated solutions, through predictive software, etc. So our offering basically is goal planning, retirement planning, investment planning, tax planning, and succession planning. We're still building the product. It should be launched by the end of this month, hopefully. So that's about it. Since I'm the last one on the list, I think I'd like to take the liberty of asking Deepak sir a question which I had missed earlier. What's your take on voluntary provident fund for at least the salaried folks? Do you consider that as a pseudo fixed income product, or?
Oh yes, fantastic it is. It's just brilliant. 8.5% they're giving.
Yeah.
So if you can do that, that's like the best thing. Unfortunately, as an entrepreneur, I've hardly had personal use for it. But if you have the option, you don't mind locking in your money for a really long time, very good option. 8.5% post-tax.
Thank you.
Okay, since we have a couple of minutes, okay, Gurudat has joined, so I call Gurudat back. Guru?
Hearing?
Yes.
My Gurudat Malya here, 74 batch.
The video is not on.
Hello, is it okay now?
Video.
Yeah. See, Gurudat Malya, 74 batch. I'm a active investor and trader. But in the group, trading is little bit hesitative mood is maintained. So I am telling everybody, trading is one of the best opportunity to make good amount of profits. In the sense, it is not so easy to say, but it has got its own plus and minus. But if you've got a big bunch of stocks of one single stock or many.
Okay, thank you, Gurudat.
You can trade every day.
Yeah, thank you, Gurudat. I think
Ganesh sir, I think we missed Alvin Narona here. He is also here.
Yeah. I wanted to call him next. Can you, Mr. Alvin Narona?
Hi, this is Alvin. I'm from the 1976 batch. Happily retired now for the last 1 year. And while I was not very active in investments, fortunately being in ITC and with the ESOPs, things started working for me when I wasn't working for it. But I have one question to Deepak. is that people of my age have started now blessed with grandchildren. Is there a kind of investment where you invest and forget, and the grandchildren directly benefit when they come of age? The kind of investment my relationship managers all say is that you invest in your name and put their names as nominees. The moment that you invest in your name, then there is that you will also can withdraw the money, etc. But you just invest and forget, and they get it after when they come of age. Is there some kind of a good investments from that perspective?
Yes, Mr. Narona, I think the idea can be done by a insurance package where you make them the beneficiary of an insurance, and there are these packages where they get some money after 18 years or 15 years or 12 years and so on. The money is locked in until that time, and then it goes to benefit them. I think though that the investment may still be in your name, which will then only transition to them in case something happens to you. But that is one thing that you could do. The other one is to, if they're only 3 years old, 15 years away, I don't know if you can do this, but if a PPF account may be possible that you can invest where the interest is actually very low. It's about 8.5%, but sorry, 7.5%, but they will get it almost tax-free, completely tax-free after 15 years. That's another way. I can connect with you separately to find out other ways you can do this. But off the top of my head, this is one way. Any investment you do, even if they're nominees, remember that all your legal heirs get access to that money in case something happens to you by law. A nominee is only a person who holds your money in trust until the legal heirs are actually determined. So it's not, nominees are not the best way to do this.
Yeah, that was a concern.
Right. Okay, thank you, Alvin. Nice to see you here.
Is there a way to get adopted by as grandchildren of Mr. Narona?
Next life.
I like that.
Okay, so I think yes. Now I think we'll go on to the next topic. Now I think we are done with the investment part of it. We have a president's slot.
Yeah.
So,
yeah.
Raj, you're there?
Yeah, I'm there.
Yeah, and in this, you can also give a couple of minutes to Raj. Of course, you are also part of it for the NITK thing.
Correct.
That's very important at this stage.
True.
You put on your video if you can.
No, I don't want to put on a video.
Oh, okay. You said you're not keeping well.
Yes, that's
okay.
it.
Okay, fair enough.
So
fair enough.
Thank you so much. It's been getting very interesting every session, in fact, altogether. So we are being very, very enthused to see, most of the activities happening. So one thing I'll tell you is, we all learned today, how to build wealth and how to manage wealth. Okay, the place where I'm staying in, the health is also important. Okay, you keep your health intact. Don't miss it out. Running behind the money. Money will come to you. Follow what you would like to do it. Okay, that's the thing. On the front of the Bangalore chapter, as you know, that we have formed the company NITK Alumni Housing Development Private Limited. So we have opened a bank account. We had identified a property, went through the legal things, and he didn't fall in place. He didn't go through the required legal scrutiny from our lawyer. Then we have to drop that, and we have identified other properties. We're going through that. So it's just a process which has been taking little time, and we'll be back in there. So the best investment for, as you all know, you also spoke about real estate investment. Best investment to invest into real estate, into your own enclave, which we are building for you. And you will certainly, get it at best price than, 25 to 30% less than the neighborhood prices. That's the first take that you'll have. So then, you will move up in terms of a development completion and all that in the next 3 years, another about 20%. So there are good chances of 40 to 50% increase in your asset value certainly will happen. Okay, and more than that, you will be more happy, more safe, more secured. Okay, so that's the one thing, and we're all there. We're working. There are about six founding members plus 2 more supporting members that we have in this team. We're all working very hard under the circumstances. So there is a good going will happen under about 2 months' time. I mean, okay, there is a registrations also opened. Raj will talk about it more because he's handling most of it. Okay, so he's front-ending most of the things. Raj, if you're there, please take over and
just 30 seconds, sir, please. That's 30 seconds. Mr. Basuraj.
Raj is there?
No, Raj is there, but if you have to say something, you can finish it, sir, please, because we're running out of time.
Okay, all right. Yeah, so yeah, that's fine. Absolutely no problem. So there is a group that we have formed and we opened a membership. Just a mere 10,000 rupees. We're taking this membership for the people to show their expression of interest out here, so that okay, we have interested people, and this money is then kept aside as your money, which will eventually get into your investment that what you make. So we already have about 50 plus people have been coming here. The first phase will be about 150 people, that what we're looking at it. The expression of interest of you coming in ends on 27th December. If you have any queries, you could talk to any of us, write to us, and we'll try to help you out. Okay, on terms of going forward in the locations, we are in the similar locations that we have identified with properties, which are well intact. Okay, we're going through the legal verifications. Once that has been done, we will present to you with a new scheme of modalities to go forward. I think I thank you everyone for this, and have a very happy New Year. 2021 is just way. I mean, I hope all our miseries are gone with this December, and I wish everyone, your families, very happy New Year. Thank you so much for all of you.
Thank you, Basuraj. Thank you very much.
Yeah.
It is no, in fact, I'll just put in one word, is that while we are on the subject of investment, NITK layout not only gives you a good real estate diversification, most important, it gives you the benefit of being with like-minded people. So look at that as the opportunity and take it forward. Over to you, Vijay Udpa.
Thank you, Mr. Ganesh Kudva and Gyan Tiwari. Well, fantastically. You did a big round of applause from everyone. Okay. Thank you very much. It has been very nice. And I just take you through, just let me know if you can see my screen.
Not yet.
Okay. Hold on a second.
Voice is breaking.
I think we can mute the others in some background noise.
Okay. I don't know who's having that. Okay. See, I have something here for you to answer. Now, all of you, I told you I'm going to have some fun today.
I'll mute all and only unmute you, sir. 1 second.
Okay. Are you
remove the unmute part?
See my screen?
Okay, I done mute all. I think I've asked to unmute Ganesh sir and Udpa sir. You both need to unmute.
Yeah, okay. Done.
Okay. You're able to see my screen right now?
No, not yet.
Not yet. Okay. Just let me know.
I think it's starting.
Okay. Thanks very much. And
yeah.
Okay. See, I told you, you all had to open on your mobile, the slido.com. Okay. Just open that website and walk through me, and there will be some questions asked. So you have to tick your opinion there, whatever you want. Okay. So that will be shown on the screen. Okay. So this is some new technology. On real time, we are going to collect the feedbacks and everything. Is that okay? Do you see that there? Those of you who have not done, just go to that slido.com and just put that code.
Yes.
We'll ask for a code. Code is 16DEC And 1 second. Okay. Do you see that on the screen? Just reply to that question as you put the question answer to that. It will appear on the screen. See, now one person has answered now. You can go ahead and answer. There are 125 people. Please go ahead and put your this one. Excellent. 6 of you are put. See, this way we are taking everyone's opinion on what is the topic needed in the next breakfast meeting. Do you like that? Do you like this?
Yeah, awesome. Something new.
Please go ahead.
Wonderful.
Go ahead. Yes, please go ahead. This is something I discovered recently, which everyone can use to keep your audience engaged positively.
New toy.
New toy. Please go ahead. There are 125 people, 106 people. Only 29 have replied on this question. Please go ahead. Health tech on the top. Go ahead. Go ahead. Come on. I don't want to keep it for a long time. Another few seconds. Guys, the code for that is there here. 16 December 2020. Okay, that is the code. You don't put that hash. Just put 16DEC2020 is the code. Okay. Go on your mobile or lap, anything.
I think the link connects you directly. You don't need to put the.
Oh, if you see that QR code, right? Yes.
Not in QR. You had sent a link itself.
Yeah. I have sent you a link also. Yes. Please go ahead. Still, there are 104 people in the call and only 42 replied. Is the technology so difficult? We got to embrace the technology as we go ahead. Come on, let's go ahead. Oh, health tech.
I think the code also in the regular camera of iPhone and Android, the normal camera itself takes the QR code and takes you to the site.
Okay, see that now the health tech took a back seat and agri tech took the front seat. 53. Come on, fast. Go ahead. Please reply. Your voice is heard here. Okay. Go ahead. I'm going to stop now in another few seconds. So this way I want to collect the topic for the next next meeting, and we will also have the coordinators identified. I'm going to stop this now quickly. There are some more questions. Be prepared for next another 2 questions. Okay. Thank you. Yes. Now go ahead. I'm going ahead to the next one. Okay. Sorry, 1 second. This is that, and 1 second. Okay, 1 second. Okay, no. Okay, this is, are you able to see the?
Yes.
Today's Zoom license sponsor for breakfast meet is.
One second, I lost the connection.
Yes, go ahead. How many of you know who has sponsored?
Already relate the news. Relate the tick the option.
Okay. I think we should be fast enough to answer now. Okay, fast. Okay, good. Okay.
Fastest finger first.
Okay. That is Beehive. Thanks to Beehive. And I think K. Rao and some of you have, I think Mr. K. Rao has won. He has answered quickly. Thank you very much.
Oh,
fantastic. Nice. Okay.
Great.
Everything online. See, the technology is very nice. Yeah, there is one more question. I don't know whether I can show it. Okay, it is not there. Okay. Okay, no problem. So there is questions and answers on your this one. You can also, okay, Mr. Karant has wished us best wishes. Thank you, sir. And I don't think anybody has any other questions, or else, yeah, Mr. BK Krishnamurthy is around. So please take 30 seconds to wish us everything. Wish us something, sir. Mr. Krishnamurthy, sir. Please unmute and speak.
Good morning, all. Thank you, Ganesh Kudva and Gyan Tiwari. I think you have done an excellent job. And this is the highest, you have made all-time record of, crossing 200. Though it was 300 plus, I knew 1/3 will sleep off like in NITK classroom. So something has happened here as well. Nothing, no surprise about it. So 200 is a very good number. I hope this technology, whatever Udpa is using also is very good, so that we get the feedback instantaneously rather than waiting, filling the form and all that is outdated now. Thanks, Udpa, for bringing new technology.
Thank you.
So I hope everybody has enjoyed and taken some Gyan out of Gyan Tiwari as well as Ganesh Kudva, and use it in their lives so that they become wealthy. And of course, now probably after this, whatever is a choice, health also can be given a priority. Maybe next time after that we can go for that. So all the best and have a happy New Year and a new Christmas as well, which is coming shortly. All the best.
Thank you, sir. Thank you. There is last question on the slide. I missed. See, I'm also learning along with you the technologies. Okay. Yeah. Your feedback for the breakfast meet. Okay, wonderful. It's super. Maintain the same. Good. Can be improved. I cannot say anything. You are all trying your best. And a lot of improvement needed. Please go ahead. Put your suggestion or feedback. So
yeah, hi.
Go ahead.
Hi, can I just say something? Is there a way for people who missed it to actually get access to the presentations?
Sure, we'll make it available. Who is that? Mr. Sujay,
This
right?
is Sujay Kamath, yeah.
Yeah, we will
Sujay,
make it available.
Hi, Sujay. We'll be sending, I think, with the permission of the speakers, we will be sending both the presentations to everybody whose mail IDs are registered with us for this event.
Okay. Because I personally missed pretty much. I had some early engagement. That's the reason why. Yeah.
Thank you very much. That's fine. Okay. So last and but not the least, we have our coordinators done a wonderful job today. They need a big round of applause, Mr. Ganesh Kudva and Gyan Tiwari. Okay. Thank you very much.
Thank you, sir. Thank you.
Bye-bye 2020. Let us welcome 2021 with a great smile and without corona or anything. Okay. Thank you.
Yes.
Thank you, Mr. Kotti.
Thank you all.
Core team.
Thank you, Ganesh. Thank you, Gyan. Thank you, Vijay.
Not virtually, really for breakfast.
Thank you. Yeah. Run for
Let's go for breakfast now.
Thanks to the organizers.
Thank you, everyone. Thank you, sir. Thanks a lot.
I will keep this for another 5 minutes and then we'll close. You can just chit chat. Thank you very much. Thanks to the speakers, everyone. We'll meet on 20th January.
In fact, thank you, Udupa, for organizing everything.
Thank you to
as usual.
And Shesh and Monappa for making it available.
It was our pleasure to be able to support this.
Thank you. Shesh.
Thank you, Shesh.
Yeah, and I think response was good. I think about 259 people in total came. I think I was just trying to pull out.
They did. Okay, I saw up to 180, 190. But
I think that was concurrent. I saw there at one point in time there were 207 in concurrent. What I saw.
Okay. Yeah,
but more would have come over time.
You will have the statistics.
Very good.
Excellent.
Okay.
I think if not for the early morning, I think we would have had many more. Winter mornings are difficult to get up.
We should do late night at 11 o'clock in the night. They'll be
yeah, possibly yes. We should try that with the glass in hand.
That will be
make it more interesting.
I think we already have our batch ready to do this Saturday. So
okay. Great.
Okay.
Yeah.
Thank you very much.
Thank you.
Thanks all.
Thank you, Deepak. Thank you, Deepak. Thank you, Parikshit.
Thank you, sir. Thank you.
Thank you. It's always there.
Thank you, everybody.
Oh, I'm scared. Thank you. Thank you, Ganesh.
Hello, Almur, you didn't talk at all.
Thank you.